I'm looking for 7,000 on the S&P, not at the end of the year, but sometime this year. I think, we're, as I've said many times, we're coming to the end of a 41-year secular bull market, and I think there's a final melt-up stage that we have entered. I think it really started back at the end of October of last year. Obviously, we had a pretty strong run into the end of the year. We paused the first week of this year, but I really think we're getting going, and that first quarter is going to be very strong. It may spill into the second quarter, but if I'm right about how fast this thing's going to get going, this could be the biggest rally in the history of the stock market.
On this episode of the What the Finance podcast, I have the pleasure of working on David Hunter. So, David, thanks so much for coming on the podcast today.
Yeah, hi, Anthony. Good to see you again.
Yeah, happy New Year, and it seems to be a very good start to the year, and hopefully it will continue, especially since with what we saw in the markets at the end of last year. So, yeah, I guess from your perspective, what do you expect in 2024?
Yeah, I am. As you know, the strategists kind of coming into this year with, flat to up markets. I mean, people have raised their estimates. I think the last 2 months of the year got some of the animal spirits going, but you're seeing, I think, the high call for the end of 2024 outside of me is maybe 5,200, and some have said if really things really stretch, could go to 5,500. I'm looking for 7,000 on the S&P, not at the end of the year, but sometime this year. I think, we're, as I've said many times, we're coming to the end of a 41-year secular bull market, and I think there's a final melt-up stage that we have entered. I think it really started back at the end of October of last year. Obviously, we had a pretty strong run into the end of the year. We paused the first week of this year, but I really think we're getting going, and that first quarter is going to be very strong. It may spill into the second quarter, but if I'm right about how fast this thing's going to get going, this could be the biggest rally in the history of the stock market.
And how big would that have to be the biggest rally?
Well, like, I don't know exactly, but 7,000 from where we were coming into this year, basically a 50% run, and I think NASDAQ will do better than that, and the Russell will do better than that. So 50% in, say, 3, 4, or 5 months. I don't know of any market that I've seen that's been bigger than that. So, I mean, that's what I mean by a parabolic melt up. It's going to be steep. It's going to be fast. And the reason for it is you really had, as you know, for the last couple of years, starting in 2022, a pretty large consensus of bearishness out there, even during this rally that's been in play, or this bull market that has been in place since October of 2022, all the way up. The money managers, the strategists, were all fighting it and saying there's a bear market rally. It'll roll over. They thought it was going to roll over at 3,800. They thought it was going to roll over at 4,000 or 4,100. When it pushed above 4,300, they got more bullish, but not with a lot of conviction. And I think we are on the verge here, not yet, but within days or weeks of evidence that is going to force those bears, or those people with not a lot of conviction on the bullish side, to have to rethink it and have to reposition themselves from a more defensive posture into a much more bullish posture. And that, what I think is going to change their thinking, is inflation is getting ever closer to the Fed's target. We're at, depending on the number you use, but we're down around 3%, heading for 2, which is a target on a 6-month basis. The number they watch closest, the consumption expenditure, is almost at their target. So on a 6-month basis, or it's at their target. So I think if we get a good number tomorrow, and if I'm right that inflation is continuing to move down, and maybe not all that slowly towards their target, the Fed's going to be forced to say, not because they think inflation's, totally, they're out of the woods completely, or that they aren't on guard. But basically, they know if inflation's moving down, the real rate is moving up if they don't change it, if they don't cut. So I think they may be forced to cut sooner than people think. And if that happens, we already know it's, most of the street, I think, accepts that tightening cycle is pretty much ended. And if cutting starts in the first quarter, even, maybe I'm not saying it's going to happen at the January meeting. Nobody expects that, but if the number tomorrow is surprisingly down, you might see pressure to say, hey, if we don't cut, that real rate's going to be moving toward 3%. That's a very tight posture. Even if they leave Fed fund rates unchanged, the real rate is going up if inflation is going down. So if you start seeing that, where the Fed is saying, we feel we have to cut because of the real rate, you may see, and I think you will see, that kind of takes away that one big thing that's been hanging over the market or hanging over the bears, saying, yeah, well, we're not out of the woods with inflation. We're not, the Fed may still not cut that aggressively, or may take their time. If it starts going the other way, they're going to have to, forget their bearish posture and get on board. Or I think they are going to do that. And that starts what I think will be a buying stampede, because you've had, as I said, all last year, you had investors all on one side of the boat. A huge consensus for a long time was on the bear side and expecting, back to the lows or lower lows, or at least a good part of the way back to the lows of October 2022. If that starts going the other way, where they say we all have, if they all decide fairly in a short time period, we've got to get bullish, or we've got to position bullish, you could have what I call a buying stampede, where you get a concentrated period of buying without a lot of people selling, or compelled to sell. And what gives on that in that kind of situation is price, and in a big way. So I've said for a while that we're going to have a broad rally into a top, that this melt up would be a broadening of the market. I know all last year everybody said, this isn't a real good bull market because, it's the Magnificent Seven. It's very narrow. Normally, as you move towards the top, you narrow. I have felt all along that, based on my analysis, we were going to see a broadening, and we saw that at the end of the last month of the year, last couple months of the year, and I think that's continuing this year. So, I fully expect a very broad, very steep rally into that top.
So why did you think there was a broadening? What was the analysis that made you think that was the case rather than a concentration?
Yeah, it's a good question. A lot of my, some of my work is what I call cross market work. I'm looking at sectors, I'm looking at individual stocks. And when you look down below the surface, there were an awful lot of charts and sectors that looked to me like they were in bullish patterns and were going to move up. So it made all the sense in the world that you were going to see a broadening of the market as that started to happen, and you saw it in spades in November and December.
Okay, that makes sense. And say if in the next few, or like tomorrow, so this interview's going out on Friday, so everyone will already know the inflation. We're recording this on Wednesday, so everyone will know the inflation read. But say if it comes maybe above target, or it increases, do you think that will have an impact on the melt up, or do you think maybe it just slow down the inevitable?
Yeah, certainly. If it's a disappointing number and comes in much higher, then all bets are off in the short term. I don't worry about data points for longer term melt up call, but it could certainly postpone things a little bit. So it's not my expectation. I certainly think you've got the whole lagged effect on the housing component, which is a big chunk of the CPI. It's a number that is more or less imputed in there, and it will be coming down as we move through this year, because it was artificially holding things up last year. So you've got that going for you. Oil's been coming down, gasoline prices have been coming down, home prices are coming down, I think, a little bit, and So there's enough things there that I would argue that the bet should be on the downside, but on any given month, you can get surprises either way. So yeah, I mean, if it surprises me on to the upside, the street could react negatively in the very short term of a day or two. But beyond that, I think the story is lower inflation, lower oil prices. Certainly, oil is trending down, and I've been the bear on the street on oil. I think oil's heading for $60 a barrel. Gasoline's been trending down. I think that's going to continue. So, there's a lot of things out there that say, the inflation problem that the Fed's still fighting is going away, at least appears to be going away.
So let's just go talk about you're talking about if you think funds the main catalyst is a lot of these funds, and it's interesting you look at a lot of them and they very much underperform the markets in 2023. So that you think they're going to get that pressure of, oh, we've been trying to fight it for so long, it's going up, screw it, we're just
Yeah,
going to go in. Yeah.
it's not. It's all institutional money managers. I don't think it's just mutual funds or ETFs. Um, it's a lot of different institutions that have been positioned bearish. The crowd's been bearish. Same thing on the retail side. Yes, retail's gotten more bullish the last couple of years, last couple of months with the tape going up, the bullish tape. But even there, I think there's $7 trillion in money market funds. I've seen some numbers that would argue that at least a couple trillion of that was people moving out of equities. Maybe there's a core of 4 or 5 trillion that's not destined for the stock market, but there's at least, I think, a couple trillion there that could turn around and go back into the market if people become more bullish. So, yeah, I mean, crowd behavior is something that I've studied for 50 years and feel pretty good about reading. And although, some sentiment numbers point to a lot more bullishness out there, what you saw in that first week of January in the market was the minute the market had a couple of days down, you saw very little conviction on the bullish side. Although, at least I saw it in my Twitter feed. Everybody's coming out of the woodwork starting to doubt this rally. I'm going, you had a, close to 20% rally the last 2 months of the year, 17% rally, and you give them back a couple percent of it, and you're ready to head for the hills. I mean, that's a sign that you can read it as bullish. I don't read it as bullish. I view it as still that same sense that yes, they'll go with the momentum, but they got one foot out the door ready to leap as soon as they see the tape turn negative. So I think that conviction bull is still ahead of us. That hasn't happened yet.
And do you think it'll be, so if we look at the Nasdaq, it's at all-time highs or it's broken all-time highs, and the S&P is sort of just on the verge of all-time highs. Do you think once the S&P breaks that, that's when we'll see the melt up, or it'll be that as well as the Fed cutting? Those will be the main catalysts.
Yeah, I mean, it's going to be Fed cutting. It's going to be the so-called Goldilocks scenario is out there right now. I think rates are about to come down again. They've consolidated for a couple of weeks. I think you're going to see another run down at rates. You could get the 10-year down to 360. You get the dollar ready to roll over here. So those are going to be catalysts. And then the sense that this is a soft landing, not a hard landing. There's a lot of sense now that a lot of talk that we may not even have a recession. Obviously, I'm calling for a global bust after this last melt up run, but the street doesn't believe that. The street is moving ever more towards a soft landing scenario. So you can have kind of your cake and eat it too scenario here, where people go, inflation's been defeated. The Fed did a good job, got inflation down. They did it without sacrificing the economy into a recession. That we're going to have a soft landing. Employment softening enough that the Fed has room to ease. And I think all of that goes together to say, well, why am I bearish? That's what I think triggers it. And again, I think it's going to be both growth and value. It's going to be both large cap and small cap. So it's not just the high tech stuff, the big tech stocks. It's also not exclusive of those. There's a lot of people wanting to say, well, those stocks had their day. Now we're going to go to. I think it's going to be both. You're going to still see, the Nvidias of the world have a big run in this melt up, as high as it is. This Magnificent Seven, I think, are still going to be major participants in this rally. And at the same time, you're going to have now, which you didn't have before, the small caps having a big run. And then you're going to have cyclicals. Industrials actually did pretty well last year, but there's other parts of the cyclical market that I think will play. And the one area that I don't think is going to be a big participant is energy.
Yeah, it's interesting because you say you think the stock market's going to go up, dollar's going to go down, as well as energy going down. Because normally, I guess when dollar goes down, it benefits commodities. Is that just that there's, the US is bringing out so much oil, they're sort of extracting so much oil, or is this more a demand issue, or why do you think it's going to continue to go down?
Yeah, I think it's both. It's definitely our production is up, and I think basically worldwide, the supply demand situation shows that I don't know if it's a glut of oil, but there's certainly an excess of oil out there, despite everybody believing the opposite for so long. I mean, and I think it speaks to the fact that underlying, no matter what statistics you look at, underlying those statistics, we have a weak global economy. So, and I think that's why I think ultimately we're going to have a global bust, but not in the first several months of this year. The first several months of this year, you're going to be able to believe things are okay economically and very good inflation and interest rate wise. And like I said, oil, the proof is in the pudding. The OPEC, how many times has OPEC tried to, jawbone it down or convince people that they're cutting production and going to get prices up? And what happens? It used to be they get a couple month reaction out of that, or at least a month. Now they're lucky if they get a couple day reaction out of it, because people realize the picture is that there's not enough demand for the supply that's out there.
Yeah, good point. So you mentioned that you think cyclicals could be like the major beneficiaries. So, what specific industries in cyclicals do you think would that be?
Yeah, I think steel looks good here. I think basically the materials area in general, copper producers, I think, are poised for a big run. They've been weak early this year. Pulling back a little bit, but I think copper producers are going to do very well. Home builders, I think, are going to continue. It's kind of an interesting thing that I think housing peaked months ago, sometime earlier last year, and yet home builders had a great year, and I think are going to continue because rates are coming down. Even with rates rising last year, even with mortgage rates going, beyond 7% last year, almost to 8, home builders did well, and the reason is because it pushed everybody to new homes. I mean, they said, hey, at least home builder will give me a break on the mortgage rate, or I can through the subsidized mortgage rate, I can afford the house that going out into the secondary market I can't, because the bank's mortgage rate is too high. So home builders, and there's a shortage of housing. That's you've seen the studies that say we need millions more homes in this country to supply the demand. I'm not sure that's going to long term prove to be the right analysis, but that's it right now. Home builders are having their day. They're still being able to build and sell, and so home builders should do well. I think the industrials will continue, even though they went to new highs last year. And I think when everybody's saying the market's so narrow, I kept saying, look at industrials. They're near their highs. So it wasn't just a Magnificent Seven, and I think that's the case here. Is that industrials have made all-time highs, and they look poised for another big run. So further run. So they should do okay. but I think it's also across the board. You know, the defensive areas like utilities will lag the indexes because they're just not going to be able to keep up with the indexes or with more cyclical areas. The tech, like I said, is not just a big tech. Tech in general, I think, will have a pretty good year or a pretty good first part of the year. And financials, that's an area that I think was obviously not thought of a lot of last year. They've come alive as rates have rolled over, and rates I think are going to head a lot lower still. I think broker dealers look great. So the big broker dealers as well as the retail broker dealers, I think could be real beneficiaries of what I think is going to be perhaps the biggest rally in market history.
Yeah, I know a few that I've invested in up sort of 30 to 40%. So already, let alone with this potential increased demand that you mentioned there. So they could be the ones who really benefit off this a lot. Um, but that's interesting how broad and the different, I guess, industries you think will benefit. So then what do you think will be the catalyst for the peak? Is it just going to be over exuberance, sort of similar to other market tops was in the past where people get so excited and then there's just people run out of fuel? Is that what's going to happen, or do you think there's going to be a big catalyst? Or
Yeah, well, let's put it this way. Markets are two things. Markets are psychologically driven, and that's the big piece that I always bring to the table is that I'm a contrarian, and I think sentiment matters a lot. And going contrary to that sentiment matters a lot at turning points. But there's no doubt that markets also are fundamental. They are driven by fundamentals. So like I said, we're kind of in the sweet spot where you can have lower rates and an economy not doing great, but it's not doing terrible, right? It's a kind of soft landing scenario. So you can discount those earnings, and the companies have shown their ability to kind of squeeze out earnings as long as the economy's not in the dumps. So you can have a period here in the first half of the year where it looks pretty good for the stock market or for stocks. But I think we are trending towards and gravitating towards a global bust. And a global bust is not just a global recession, it's something worse. It's, yeah, the simplest thing I say is it's worse than 2008-9. It comes with a financial crisis, and I think that financial crisis, as bad as 2008-9 was, this one could be worse. The leverage in the system is much higher. The fragility of the system because of the pandemic earlier this decade, because of that pandemic, underlying the economies is a lot of problems and weakness. So, both here in the United States, but particularly in Europe, you've got all the issues that come with the energy issues, et cetera. So I think second half of this year might look very different than the first half economically. That could be part of what ultimately tips things over. Another interesting thing, this is, I can't know this is going to happen, but my bet is that let's say Powell starts cutting. Let's say the Fed starts cutting here, first quarter or certainly second quarter. Maybe they hold their powder and they just don't hike. Either way. But if we get what I'm calling for, which is a melt up to S&P 7,000, and I had been saying 6,000 to 7,000, I've raised that 7. I took the bottom range off. That's how bullish I am. If we get this thing pushing over 6,000 on its way to 7,000, I think you're going to see Powell and his FOMC members look at that and say, we got to hike again. The animal spirits are just too strong here. Keep in mind, in April of 2022, Bill Dudley, the former head of the New York Federal Reserve, the economist from Goldman Sachs, in April of 2022, he delivered a speech where he talked about the importance of getting the stock market lower because the stock market was part of the financial conditions out there. So if you had a strong stock market, you really weren't tight because people could use that wealth they were building in the stock market to spend. So he felt a component of tightening, because the Fed was just beginning its tightening. He spoke strongly about the need to get the stock market down below 3,000. That was his, talk. At the time, obviously, the market was up over 4,000, and people got pretty bearish. Powell bought that hook, line, sinker. He really believed Bill Dudley was correct, that the stock market was a part of what they had to focus on. And you could tell that from that April date all the way through last year. Every time the stock market had a rally, particularly after a Fed meeting, if they got excited that, hey, maybe we saw something in Powell's words or in the minutes or what have you that indicated the Fed was almost done, the market would rally. He sent out his fellow governors one after another to talk the market down, to say they're misreading things. We're still hawkish. We're still on guard. We still think inflation's our job number one, and that we haven't finished our job. We think it's higher for longer. All those terms that were out there, all those words were aimed at the stock market because they felt the stock market was too high and needed to go south, and south by a lot. By early this past year, by early 2023, because you had that big rally between October of 2022 at the bottom, 3,500, and by January, February of 2023, it was up to 4,200. All that time, he had been jawboning. The market would take his jawbone and go the other way. It went up. So he finally, in the first quarter of 2023, kind of backed off being quite so obvious about trying to talk the market down. He would still give some lip service to it during his press conferences after Fed meetings. And you could tell he was very cognizant of how much the market was listening to his words. So he tried to give still a bit of a hawkish tone to his talks, even if they were showing some signs of easing or backing off their tightness. And then that it continued through the year, and even later October, fall of this year, when the market really took his words more bullishly, he didn't really fight it as much because he knew, I think he was starting to realize, I'm looking pretty silly here. I'm trying to jawbone it down. The market's ignoring me and going the opposite direction. So, but deep down and under the surface, you can tell he still kind of buys into that Dudley view that market is a part of financial conditions, and if it's rising, it's it's offsetting some of our tightening. So if we get a market that is 6,000 on its way to 7,000, I think you're going to see the Fed potentially come back and hike again. Now, what they may be doing is hiking while the economy is continuing to trend down into a recession. They might ignore, let's say if we took the stock market out of the picture, they might be saying, yeah, we got to ease some more, or we want to continue our easing here because the economy's, going south. But because the stock market's part of this, it might distract them from what they'd say based on the economy. And they might actually say, yeah, maybe we have to worry a little bit that the economy, the economy's not falling apart, and the stock market is showing that there's too much speculation out there. And plus, not just Dudley, this whole thing about Fed put, that the predecessors to Powell were guilty of propping up the market constantly, and he's been very clear that he doesn't want to be guilty of that. So all that stuff tells me if you see a strong market, he's going to have a tendency to want to retighten. And if you get hikes, one or two hikes, when you're on the verge of the economy going the wrong way, faster, meaning it's in recession on its way to, a hard landing, that could be a terrible error. And so I think that could be a contributing factor. It's not that that's the only thing that pushes you into a global bust and what I call an 80% bear market potential. But it could be the thing that tops us out and gets us going that way.
Yeah, I'm not too sure if I agree with that because I think it'd be very unlikely for him, especially if markets, if markets going up and inflation is stable and employment is strong or is maybe weaker than expected. I don't see why he would increase interest rates because from his perspective, it makes him look great. And if he increases interest rates, and he's basically just going to potentially screw up the system. And yeah,
Well, but you have to understand, I'm, as much as I criticize Powell for some of the stuff he does, the one thing I've always consistently said about Jay Powell, I think he's sincere in his efforts. I don't think he's playing, I don't think he's worried about um, how do I look or how, I think they're and I'd say the same thing about most of those governors. Most of them are really focused on um, if we don't get inflation, if we don't defeat inflation here or get it back into the bottle, our job's going to be much tougher down the road. So if they believe that the stock market is part of pushing inflation the other way, getting, loosening conditions too much, I think they would say to be cautious, we might be better to, hike a little bit here rather than, don't forget, he also has hanging over him the memory that he and the criticism he gets often that he waited too long to fight inflation, right? That he let inflation go. And then it, became so. I think that's in the back of his mind too. So again, I'm not saying it will happen. I think it's a possibility that might be a higher possibility than you might think. Um, and again, if the economy's falling apart, he's not going to do that. But if the economy is still hanging in there, not good, but hanging in there, and you get this big run in the stock market, I would not rule out the fact that he could come back and hike again. Now, going back, I have the advantage of having been around in the early '80s. Not too many people around today uh, were there to remember that we had a double dip recession. And we had the Fed tighten and then ease and then tighten again. So it's not beyond the Fed. They're not linear. They can go both ways. So I would not rule that out.
yeah, it's a good point. I think there may be hold rates for longer potentially rather than increasing. But we'll see. You never know. As you said, if people get too excited and then they start spending more money, and then that could have a massive impact on inflation. But you have mentioned that you think there's sort of some underlying issues in the economy even at the moment. So what are you currently seeing that is, not from a market's perspective, from the market, you think it's, blow off top, but for the economy, you think there's maybe some something looming in the future. What are you currently seeing?
Yeah, I mean, you know, delinquencies, car delinquencies are up a lot. Savings is down a lot. Savings rate is down a lot. Um, the all the banks themselves have really pulled in the reins in terms of lending. There's a lot of signs out there that we're in territory that is very close to recession in terms of that kind of behavior and those kind of statistics. So I think the consumer is pretty tapped out. What we saw last summer, the consumer, did a lot of travel, and some of the consumer spending for bigger ticket items fell off. Then the bigger ticket items came back, or Christmas was strong, and travel's backed off some. They just don't have the wherewithal to do both. And now I think they may have kind of pushed. Christmas wasn't super strong, but it wasn't weak. They may have kind of had their last hurrah because I think consumer is not in a great place. And so I think as we go through this year, we'll see the consumer tail off. Um, and again, I'm focused on the U.S., but over there, things are worse than they are here. So, and obviously China's in rough place. Japan's a wild card out there because rates there, inflation and rates, I think they've lagged us for sure. You had the inflation problems in Europe and the US and Canada and Australia. Japan's been able to continue their called MMT or whatever you want to call it. They're, keeping their rates in a very tight band near zero, they obviously are starting to feel, that's starting to pressure to the upside. I think you're going to see you can't print money, which is what it takes to keep rates down artificially. You can't print money at the rates they've been doing and not have it at some point cause inflation to break out. If inflation and interest rates break out there, Katie bar the door. I mean, they have real problems because they've done so much to restrain. They've been able to kind of have that perfect enclosed system. Everything I see points to higher rates there, higher yen versus a dollar, and more problems ahead for them. If it really becomes very problematic, they could be the wild card in the bust.
Okay, yeah. So that's really interesting what you're saying about Japan. I guess from their perspective as well, they're close to 300% debt to GDP. So interest rates increasing, it might be a similar effect where stock market might go up in the short term because all this capital is coming back to Japan. But after that, there's going to be real issues throughout the economy, it seems.
Yeah, absolutely. I think that's a precursor of what can come down the road for all of us. Late this decade, if we get the bust, and then we get what I think we'll get in terms of a reaction to the bust on the part of the central banks, meaning massive money, it will jumpstart a big inflation cycle where I think inflation in the US could get to 25% by the end of the decade. If you get 25% inflation, you're going to have 20% interest rates. We can't afford, we can't service our debt as a government today at 5%. It's troublesome. Imagine what it is if it's 3 or 4 times that. So that's kind of what I think Japan may run into at much lower rates because of their debt to GDP and the way they've kind of managed things there. Again, they're still keeping in tight bands, but at some point, money does matter. I'm a monetarist, and I just don't think you can continue to monetize the debt and not have it spill over into inflation.
Yeah, I agree. So if that were the case, if we were to see 25%, that I'm not too sure if I think we'll see that. I feel like sometimes the system can just find ways to get out of it. The Fed can come in, as you said, maybe it has to come to bite us one day. But if we get 25% inflation, does that mean that some of these assets, most equities, are probably going to outperform, or do you think that they're going to struggle during that period? Because you think that it would be worth holding assets.
Well, we're jumping ahead because keep in mind, I'm calling for an 80% bear market. So, you get the run up to 7,000 on the S&P. If you got an 80% bear market, you're down to 1,400 on the S&P. You can come out of the bust in, let's say, second half of 2025, or maybe it'll be sooner, but and you could triple or quadruple that 1,400. And again, I'm just throwing numbers out there. It doesn't mean it's precisely going to do that, but triple 1,400 is 4,200. Quadruple 1,400 is 5,600, right? You're not anywhere near 7,000. So you can have a big cyclical bull market run coming out of a bottom, but not come close to the highs. I think the highs we make in this melt up in this cycle, the top of the what I call 41-year secular bull market, I don't think you'll see those highs again for decades. So yes, there's plenty of room coming out of a bottom to have equities play for, certainly the first couple of years of the next cycle. But I think equities are not the big asset in the next cycle. The big asset in the next cycle will be, or certainly not indexes. The big asset in the next cycle will be commodities and commodity producers. So, would I rather own, the Magnificent Seven, going into the next cycle, or would I rather own, copper producers and energy producers and gold and silver producers? That's where the money's going to be made. I think next cycle, those will be your leaders. Doesn't mean tech won't have its play. There's always going to be some new technological advancements that make you money in those stocks. I don't know what they are, but So, there'll be parts of tech that will play, but I think large cap tech is not going to be. This was the cycle for large cap tech and for tech in general. The next cycle, I think, with interest rates moving up with inflation, that's a huge headwind for them, for growth stocks to overcome.
Yeah, it would be interesting to see. So, when we see that 80%, do you think the Fed will come in? They'll try to save the market, but they're just not going to, as you said, there's going to be that inflation, or there's going to be this issue with monetizing the debt that's going to prevent them from actually saving the markets? Or do you think it's just going to be such a big boom that they can't do anything?
It's real. I mean, it's very predictable. I think that's the easiest part of my forecasting, is that when you get into a free falling financial system, which is what I'm calling for, a global bust. So in a lot of it's over your way. It's not just the U.S., but when the worldwide financial system is at risk and free falling, similar to what it did in 2008-9, but this time I think harder to stop, they will have to shovel money into the system to save it. They can't stand by and say, well, we're not doing that again. We can't, we don't want to do QE again. We promised everybody we wouldn't do that again. They're going to say, what do we have to do to save? Go back to 2020. You saw $5 trillion. We had never seen money like that come out of the Fed, right? The whole Fed balance sheet from its beginning, in 2008, in October 2008, the Fed balance sheet was $875 billion. From beginning to then, from 1913 to then, it had never been higher than 875 billion. In March of 2020, beginning in March 2020, it expanded from 2 or 3 trillion up to 9 trillion, right, over the next couple of years. So we saw that they, even though they don't like to do it, if you're the only thing they have to deal with a problem of that magnitude, a free falling system, is money. So they will shovel money into the system, and that will be every central bank, ECB, Bank of England, Bank of Canada, Australia, Bank of Japan. So you will see money coming out of every corner in magnitudes we've never seen before. I have said several times in the last few years, I fully expect the Fed balance sheet to grow beyond 30 trillion. So it's got up to 9 trillion in this cycle. It's backed off with their tightening to under 8. I think it'll go to over 30. That'll be what it takes to save the system. And, proportionally equivalent coming out of every central bank. So that's money like we've never seen, magnitudes, I mean, multiples of what we've done before. 5 trillion was unheard of here. And I'm talking about something like 4 times that. I mean, we're throwing out around trillions like they mean, like they're $100 bills, but it's massive money. By the time they realize they've gone too far, inflation's been jump started. It'll take a couple of years coming out of what I think will be a deflationary bust. So it won't be till, say, 26 going into 27 where you start seeing inflation really starting to ramp up. But I think it goes very quickly from mid-single digits to high double digits, over the course of 2 or 3 years. So by the time you get to 2030, you could see inflation. Now I say 25%, it could just easily be 18 or 20, but it could be more than 25. The reason that I can talk about numbers like that is because we've never had that kind of money pumped into a system. You overwhelm a system with money, and with a lag, you're gonna have an inflation problem that you've not had before. Like I said, I was doing this back in the early 80s, late 70s, early 80s. I saw us go from 4 or 5% inflation to 20% inflation, in a matter of a few years. And this time, the money that we're talking is so much beyond what we did in the early 80s. So I mean, yeah, in the early 80s. So that's why I feel like we're heading for something we can't control. And the problem is you're getting to a point where it takes so much more when a policy error is made, like staying too far on the tight side, too long on the tight side, and creating a hard landing. We've had that several times. We had it in 73, 74. We had it in 80, 80, 82. We had it in the, early 2000s. The, the thing is, each time it takes more to pull us out of it. And the leverage is so much more than it used to be. We've got 320 trillion in global debt. We've never been anywhere near that. We've got quadrillions in notional value of derivatives. We've never had that before. That leverage creates so much more volatility. So that's why I think you can have these big ups, big downs, and then big ups again.
Yep, so a lot of movement. I guess we won't be bored over these next few years. But yeah, David, thanks so much for your time today. I really appreciate it. And yeah, thanks again. You were one of the first. I think you're the second person to be on the podcast 4 times. So I appreciate you coming back, sharing your wisdom. And I think the viewers very much enjoy that. So if anyone wanted to find out more about your work and what you do, where would the best places for that be?
Sure. Thank you for having me, Anthony. It's always a pleasure. So I'm on Twitter every day, or X, whatever you want to call it. My handle there is at Dave H Contrarian. So not David, at Dave H Contrarian. And like I said, I'm on there most every day. I reply to a lot of people. So I try to use my replies as a way to kind of educate. I don't do a lot of initiating of tweets anymore. I used to, but I found that this was probably the most effective way. So my reply may be to one specific person, but it's meant to convey, the answers lots of times are meant to help educate a broader audience. And then I also write a quarterly letter. It's not for everybody. It was an institutional letter. I've been writing it for a couple decades, but I did in recent years move it over to offer it to retail customers too. And so I tell people if they want information, it's not free. It comes with an annual cost. If people want information on my letter, just direct message me on Twitter, and I will get right back to you with details.
Perfect. I'll put your Twitter in the description below. But David, thanks again for your time. Really appreciate it.
Okay, Happy New Year, Anthony. Should be a fun one.
Yeah, definitely sounds like it. Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.